Let's do a little case study. Taken in London is the name of our movie. So let's take a look at how we're going to put this movie together. We have an action thriller for $10 million. It's a commercial movie, and we'll talk to our sales agent about the potential cast that we're thinking of attaching and our director. And the sales agent confirms that they believe that they can generate 75% of the budget to be covered from international distribution rights revenues. And they also believe that 35% of the budget in pre-sales is realistically. So we are assuming for a finance plan that our take level, meaning our low price level for international distribution rights revenues, is going to be 75% of the budget. So for $10 million, that's $7.5 million. And international pre-sales are going to be concluded at 35% of the budget, which would be then $3.5 million. Now the distributors pay us 20% of a down payment, 20% of a down payment, and 80% on notice of delivery, which is the sales agent who lets them know the film is now finished and we're going to deliver the film to you, and your balance of 80% is now due for payment. So we have 20% that we can use for a finance plan when we cover a portion of a budget, and then the 80% is going to be given to us, or not actually, well, to us, yes, but we use it to pay the bank back, and I'll get there in a minute. So 2 installments is normal with distributors. They usually pay 20% down and then 80% on delivery. After we're finished with the film, we're going to sell the US rights for 35% of the budget, which is $3.5 million. And because we're selling this after a film is finished, we can't really use it in a way of having the bank give us a loan against it, because it's not happening yet. It's going to happen when a film is done. So at that point, we're going to screen the movie, and then we have US distributors look at it, and then we get an amazing bidding war, and we're selling it for $3.5 million. So let's look at some of the financial considerations for our funding sources. So we are going to do a pre-sale loan. Our pre-sales, remember, were 35% of the budget. That's $3.5 million. And the senior lender looks at our contracts and says, yeah, these are great contracts. I'm going to put them in a category C, which means I will give you 80% of these contracts as a loan. So we're going to get 80% of $3.5 million as a loan provided to us from the bank. And then the bank will charge us an interest of 9% for the term. The term in this case is usually 2 years. So this is 9% altogether, and they will deduct this interest up front. So they basically put together an interest reserve. The gap loan is going to be a loan against unsold rights. Now the unsold rights are put together by us looking at what were our international sales estimates. They were 75% of the budget. How much of that have we then sold, which was 35%. So we're left with 40% of sales that we can still make, because 75% minus 35% leaves us with 40% of unsold rights. Now the bank will look at the 40% of unsold rights and say, you know what, I want 200% coverage. So I will only give you $2 million because I need $4 million to cover it. So let's say the bank would have given us just $1 million. They would have wanted to see $2 million in unsold rights. That is what this 200% coverage refers to, or easier said, whatever unsold rights you are left with, you would just divide it by 2, and then you would know what the gap loan would be. Now remember that the bank will never give you more than 20% of your budget as a gap loan, no matter how many unsold rights you have available. That's the maximum. So in this case, we're going to get 50%, which is $2 million, because we had $7.5 million in estimated distribution rights revenues. Of that, we pre-sold $3.5 million, so we're left with $4 million, which gets us to a gap loan of $2 million. And we're going to look at that a little closer when we put our finance plan together. So the interest for this is 12% for the term, and the bank will also apply a 75% legal and loan fees. So that means that all these costs, interest and legal and loan fee, will be deducted from the loan amount, and whatever is left is what we will have available to cover our production costs. We also have a junior lender who provides 5% of the budget, and they will not apply any interest, but they want an executive producer fee of $125,000, and that is going to be deducted from that loan. they will also want us to pay their legal fee of $25,000. So altogether, we're going to pay $150,000 in fees of the junior loan, and that will be deducted when we know how much it is. We're going to figure that out in a minute. The junior lender will, instead of charging us an interest, charge a premium, and that premium is based on the loan amount that they give us, meaning the gross loan amount, not the net loan amount, and that will be paid from distribution rights revenues in the recoupment schedule because it is a premium and not an interest. Premiums are always paid in the recoupment phase and interests are always deducted upfront. And there are a few more finance sources we're able to secure for our movie and to cover our production costs, and that is a production incentive, which is going to be given to us in the value of 25% of the budget. So the incentive lender looks at the budget and looks at the estimate that is provided by an accountant that they approve, and will then say, okay, 25% of the budget is going to be the incentive, and we will provide a loan against it in advance, and we will charge a 15% fee of this incentive loan amount, and will also charge $25,000 for an executive producer fee, $50,000 for an executive producer fee and $25,000 for a legal fee. And all of these costs are deducted from the loan amount, from the incentive loan. The incentive lender will then later go and be repaid through the incentive region directly. So they will not get paid by us. They'll get their money from the incentive region, which is why this loan is effectively a non-recoupable finance source for us. And then with brand integration, so we are working with a brand. The brand agrees to give us 3% of the budget, and the advertising agency we use to help us with this brand integration component charges us a 50% commission, which is deducted upfront. We're also working with a music investment company, and they will give us $120,000, and their recoupment takes place from the revenues they achieve through the music royalties. So again, this is not a loan that we have to repay. The music investment is repaid through another asset form through the music royalty rights. The equity investment is going to cover the balance that is needed after we applied all the production financing opportunities here into our finance plan, sum them all up, and whatever is left is going to be covered by the equity investor. The equity investor will do the deal under industry standard terms, meaning they'll charge us a 20% premium on their investment, and they'll expect to get 50% back-end profit participation of the percentage that reflects their investment in relation to the budget. We do have some other things to look at for expenses. We have a collection agent, and the collection agent charges us 1% of all the revenues that will arrive in the collection account, which is the escrow account they manage on our behalf and on behalf of the project. The sales agent will also be charging us a sales fee as well as an expense fee. So they're charging us 50% sales fee and 1% distribution expenses from all worldwide sales. This sales agent will not just sell international rights, but also the US rights. So they charge us altogether 16%. And they will defer their fee after the senior loan has recouped. So when we get the down payment, the 20% that the distributor pays to us when they sign the deal, the sales agent will actually not deduct their sales fee at this time, even though they could. So they will not deduct anything. They'll allow us to keep the down payment to cover a portion of our budget, and then they will deduct the entire sales fee on all the sales they generated from revenues. And then we also need to talk about profit participations. And as the producer, we're going to pay the director and cast each 15% in profits. So the question now is, how much money are we, the producer, making in profits? So first we take a look at the valuation of our project. We know we're going to spend $10 million. And the international sales agent told us that international sales are estimated to come in at the take level, meaning the low level, at 75% of that, which is 7.5 million. We're going to conclude 35% in pre-sales. 35% of 10 million is 3.5 million. And we're going to note that we have unsold rights available, which is 4 million. This is simply 7,500,000 minus the pre-sales of 3,500,000, leaving us with rights that we can still sell for $4 million. And then we have distribution rights revenues for the US at 35% of the budget, which is $3.5 million. So when you take all the international sales estimates and you take the US revenues together, you're going to receive $11 million from worldwide distribution revenues. Let's take a look at our funding schedule for a senior loan. We had the original pre-sales at $3.5 million. These are the pre-sales we have accomplished. They are distribution agreements we have closed. And these pre-sales are now removed from our sales estimates, which were our projected international distribution revenues. So now from these projected international distribution revenues, we are removing the pre-sales because we now have actual deals in place. So our pre-sales are altogether $3.5 million. And the bank says, I will discount your agreements and I'm going to apply a category C discounting, which is 80%. So of the $3.5 million, the bank will allow a loan amount of $2.8 million. The bank knows that the distributors gave us 20% of the pre-sale agreements, which is $700,000 as an advanced payment, as the first payment due on closing of the distribution agreement. So the actual loan amount that we are then left with is $2.1 million. On that, we're paying 9% interest of $189,000, I'm sorry. So the pre-sale loan amount would then end up being $1,911,000. So this is the loan amount that is given to us based on the actual pre-sale distributions agreements we have completed, minus the down payment for these distribution agreements we have already received and can be using for our financing. And so we're left with a bank loan for pre-sales of $1,911,000. Then we have our gap loan. The gap loan is driven by the unsold rights. Now, when we look at all our sales estimates and we are deducting our pre-sales, we're left with $4 million in unsold rights. These are the rights we could still sell. These are distribution agreements we can still make. The bank will look at that and say, that's great, you have $4 million you want to sell. I will give you 50% of that, meaning I will give you $2 million. The bank requires a 200% collateral, meaning they want to see $4 million available to cover the loan, which we have, and they give us $2 million as a gap loan. They apply a 12% interest and a loan fee of $75,000. So we're left with $1,685,000 of the original $2 million gap loan. So altogether, we are looking at a net loan from the bank of $3,596,000, which we can use to cover a portion of our budget. And we're going to have to pay back $4,100,000 because we have to pay the interest, the loan fee at the time we are making money, at the time distribution revenues are coming in during the recoupment phase. Our junior lender said they're going to give us 10% of the budget. That's $1 million. We're going to pay $25,000 legal fee, a $125,000 executive producer fee. So all in all, we're left with $850,000. And we're going to get an incentive loan, and that was 25% of the budget. So that's $2.5 million. We're asked to pay a 15% fee, which is 15% of 2.5 million, so $375,000. We asked to pay a legal fee and an executive producer fee, altogether $75,000. So that means we're left with $2,050,000 to cover a portion of our production costs. The brand integration amount was 3% of the budget. That is $300,000. We're going to pay the agency who got the deal for us 15% of that. So that is $45,000, which means we are left with $255,000 from brand integration. The music investment company is going to release $120,000 to us, and that is why we're adding it here in our finance plan. So now we have to figure out what our equity would look like. And the way we find out what we need in equity is by looking at all the finance sources we have established so far. So what we have established so far is we received $700,000 as the first down payment that was provided to us by our distributors from our pre-sales of $3.5 million. 20% of that was $700,000. And then we received a bank loan for $3,956,000. We received a junior loan of $850,000, a production loan for the production incentive of $2,050,000, a brand integration sponsorship of $255,000, and a music investment of $120,000. So all these finance sources together come to a subtotal of $7,571,000. So what we need in order to reach our $10 million budget would be $2,429,000 in equity. So let's summarize our finance plan for our $10 million feature film. We had our sales estimates that were projected distribution revenues from international distributors, and they were at $7.5 million, which is 75% of our $10 million budget. Of that, we then secured pre-sales, actual distribution agreements of $3.5 million. The bank will apply a Category C discount and give us only 80% of that, which is $2.8 million. The distributors paid a 20% advance payment, a down payment of the $3,500,000, which is $700,000. So the bank loan, after we're applying our interest charges for pre-sales, would come to $1.9 million and 11. The unsold rights, when we're taking our $7.5 million sales estimates and we're deducting the actual pre-sales that we then concluded, we are left with unsold rights of $4 million. $7.5 million minus $3.5 million is $4 million. Because of our unsold rights value of $4 million, the bank will give us a gap loan of $2 million. And that is because the bank requires a 200% collateral. So if you would get $1 million gap loan, the collateral would have to be $2 million. We're getting a $2 million gap loan, so the collateral would have to be $4 million, which we have. The bank will apply interest and loan fees, and we're left with $1,685,000 for our gap loan. So altogether, our bank loan is $3,596,000. This is what we now have available in addition to the $700,000 of the down payment that we already received. Next in line, we have a junior loan of $1 million minus all the fees. We're left with $850,000, which we have available to cover our production budget. The production incentive of $2.5 million is cash flow to us by a lender who applies all kinds of fees, and we are left with a net production incentive loan of $2,050,000. We have brand integration applicable of $300,000 minus some fees, which will leave us with $255,000, and we have a music investment of $120,000. So altogether, we have $7,571,000 and then need $2,429,000 to reach our production budget of $10 million. So let's take a look at our recoupment schedule. We have now produced a movie. Everything is ready, everything is finished, and we're now going out there and we're selling our film. So when we started looking at the valuation, we looked at potential revenues from international distribution of $7,500,000, and we're looking at US distribution revenues that we believe to be $3,500,000 after the film is finished. So we're now basically receiving those revenues, and we're making $11 million in worldwide distribution revenues. Now in this case, after we're applying our finance plan and after we have done our pre-sales, we know that we have received $700,000 from pre-sale down payments already. So we have to deduct this now because we don't have them available to go into our waterfall because we already received this money. We use it for production budget. So for our recoupment waterfall, we will now take it out because it's already been received and used. So what we're left with in order to have all the payments done that we now have to do in our waterfall is $10,300,000. That's $11 million minus $700,000 down payment. So we're left with $10,300,000 that we can now use to pay back our loans, to pay back our investors, and to see how much profits that we're left with. So now we're going to go into our recoupment schedule, and we're starting to pay some expenses back and some distribution fees and our loans and our investments and so forth. So first in line is the collection agent, which is our escrow agent in essence, who will handle all the distribution revenues and handle all the payments that need to be made. So the collection agent for their service charges 1% of all the monies that hit the collection agent management account. And we have received $10,300,000 in the collection account. So the first fee to the collection agent is 1% of that, which is $103,000. The sales fee is driven by 15% of the worldwide distribution revenues. So that would be 15% of our $11 million, because the sales agent in our case also handles domestic rights for this example. So all our distribution worldwide revenues are 11 million, as we mentioned earlier, so 15% of that is 1,650,000. The sales agent would also charge expenses of 1%, so that's 110,000. Our senior loan that we have to pay back, which now includes all the interest fees and all the loan fees, is $4.1 million, as we mentioned earlier. And our junior loan was $1 million. So now the junior lender requires a 10% premiums. Premiums are paid in the recoupment schedules. They are based on the investment and they're added to the investment or to the loan. So in this case, the junior loan was $1 million. The premium was 10%. We're adding $100,000 as a payment that goes to the junior lender. The equity investment was $2,425,000. The premium here for this investment is also 20% in this case, and it is $485,800. So we have also here a premium like we have with the junior lender that is added to the amount that has been given to us. So altogether, when we sum up all these expenses, we have expenses of $9,977,800, which leaves us with a net revenue of $322,200, which is basically the $10,300,000 in revenues minus all the expenses of $9,977,800 gets us the net revenue of $322,200. So let's look at profit participation. As we mentioned before, the waterfall is structured in a way that the loans and investments and premiums and distribution costs and expenses and any other expenses are paid in a ranking order in the recoupment schedule in the waterfall. Profit participation are not paid in a ranking order. All the profit participants are paid at the same time. So in our case, we have 30% going to the cast and director, so they get 30% of $322,200, which is $96,660, and the equity investor gets 50% of the investment provided to us in relation to the budget. So for example, if an equity investor would finance 50% of our budget, they would be entitled to 25% of profit participation. If an equity investor would finance 30% of a budget, they would be entitled to 15% of profit participation. Now in our case, the equity investor had provided us with 24.29% investment in relation to the budget, which is why he will now receive a profit participation of 12.15%, and that comes to $39,131. So altogether, we're paying profit participants $135,791, which leaves us, the producer, with a profit of $186,409. So this was our case study walkthrough. If you have any questions about this case study, please email me on Canvas or feel free to set up a one-on-one session and I'm happy to walk you through it. You're going to have a discussion coming up that relates to this case study. So make sure you watch this video, maybe watch it once or twice if you're not sure, so that you understand all the different steps we took in order to arrive to the producer's profit.